how a few things went in relation to the pre-release document. In particular, I'd like to know how trigger identification went. So do you think this was clear, one of those clearer triggers that you were able to pick up? Sorry, my generator seems to be back, so I'm going to put my camera on so you can see me for anyone that hasn't met me. And I'll switch my video off at some point later on. So I was saying trigger identification. How did that go? Was it easy to pick up the trigger? Was it clear? Was there one or maybe numerous ones that you had to deal with? How did the research go? So you had to look at the sort of how we interpreted the triggers and the work that we would have done. Were we aligned? Were we misaligned? How did that go? And any other thoughts in terms of the pre-release document or anything that came up in your reflection? I'll be more than keen to hear your thoughts. Hi, Atara, you can jump in. Thank you.
Thanks, Asen. For me, when I was looking at the reflection, I heard you speak a lot about IFRS 15. For some reason, my mind didn't really go to IFRS 15. I think I got stuck. There's someone talking. I think I got stuck on the other issue of, okay, they're exchanging the debenture in exchange of non-payment of tuition. I think I missed the revenue part. So my research and obviously the information of the day did not incorporate revenue in that sense.
Okay, so I take it then your research was centered around IAS 32 and IFRS 9 for the debenture.
Yes, mostly, but I just really never got to know what I was going to do with that other a reduction of, or I mean, sort of them not having to pay the parents not having to pay the tuition. Like it, yeah, I didn't know what it was, but I heard you talk about the service. It's like debentures in exchange for services rendered, something like that. I liked that, but
Sorry, you're breaking up. I'm not sure if it's just me.
She's muted.
okay,
so it's not just
back.
Yeah.
Wait, what did you lost here?
You said something. You were speaking about the services. So instead of settling the debentures, you said you like that, and I'm not sure what your then we lost you.
Oh yeah, I was saying I liked that point. It was a good point. It made sense. And I think, yeah, that's the answer I was looking for all along. But unfortunately, it didn't come through on my research and the information of the day.
Yeah, completely agree with you, Atara. That it was quite a tricky one. That this debenture trigger, in that there were a few issues here that were not readily apparent in terms of the terms and conditions of these debentures. So the first key thing that I mentioned in the reflection video is that I'm hoping not many people fall trapped to is just seeing the word debenture and immediately just thinking IFRS 9 and sort of siloing your thinking to just IFRS 9. So just a point of when it comes to accounting, avoiding thinking about the legal form when you read stuff, as opposed to trying to drill down in terms of what the substance is of what is going on. So just to unpack that point, at an APC level, you're going to have to get used to scoping transactions into standards. So at an ITC level, it's quite nice because the required will tell you discuss in terms of this IFRS, discuss in terms of that IFRS. As soon as we come to at an APC level, now that ball is in your court, right? So you're going to receive terms and conditions. In the pre-release, it's likely to be not all the information that you need. And then from there, you sort of need to unpack what's really going on here and which standard am I scoped into in terms of determining what the accounting implications are going to be. So in this particular case, absolutely, this conversion into the service, or rather the fact that this debenture is settled by converting them into tuition fees, that the sentence alone is quite unclear. You get a little bit more clarity in the brackets, where it says instead of settling the debentures in cash, we will excuse the payment, these payments, the parents or sponsors from paying the tuition fees. And if you think back to sort of IAS 32, this instrument is essentially, a financial liability is an instrument that is either settled in cash or another financial asset. So you sort of have a little bit of a clue here in terms of that this debenture is a financial asset, financial liability, in that it is settled by de-recognizing, or rather excusing, the parents from paying tuition fees, which would ordinarily be either like a receivable or like a cash settlement amount. So that's like the IAS 32 leg of it. So in unpacking this, to pick up the IFRS 15 side of it, is that services are still being provided, which is the tuition to the children, and that's being settled again through this debenture. So there's almost like two legs to this transaction. The one side being the debenture, which is settled by forgiving the fees, and the other side being the tuition service, which is settled by that debenture. So those two, IFRS 9 and IFRS 15 legs coming through, and you needed to essentially research both to be comfortable with dealing with point number 2. I hope that clarifies and sort of does a little bit more in summarizing the thinking in terms of that one. Oh, sorry.
It does. Thanks.
Oh, somebody else switch off the camera. Okay, good, wasn't me. But I'll switch off my camera in any case to save data. Okay, any other thoughts, guys, in terms of the pre-release document, or reflections, or triggers, before we jump into the information on the day? Jump in, Rutendo.
Okay. Good evening.
Good evening.
Okay. I'm not quite sure about whether my question will be valid or not, but from the exam, or when we were in the exam, the thing that I saw mostly was this trigger had too much things that needed to be done. So I'm not sure if my issue was on planning or was on time allocation or what, but I felt like it was one of the most overwhelming trigger that we had. It had too much information and too much stuff that needed to be done. So I'm not quite sure if it was me only, or I'm not sure, but I think it was too much of a trigger. I'm not sure whether the examiners thought about that when they put this thing down, or this is me maybe going way overboard. I'm not sure.
No, you're absolutely spot on, and I think that point of there being too many triggers or too many things to do is quite apparent when you look at all these slides. Right? How many are here? There's 1, 2, 3, 4, 5. Yeah, almost 5 slides of work that needed to be done to comfort yourself of all the issues that were triggered in this task. And I 100% agree with your sentiment there. This task had a significant amount of issues, and a significant amount of issues triggered, rather. And on the day, you therefore run the risk of spending maybe a little bit too much time, or writing a little bit too much in terms of sort of your response. So that observation was fantastic, and I'm glad that you picked it up on the day, and I'm hoping you incorporated it in your planning, because ultimately, when you look at I think you were given 8 tasks overall in this case study, if I recall correctly. There'll be some long tasks, there'll be some shorter ones, and you sort of have to manage your time within that context. So this could have been the one where you allocate just a little bit more time to get through it. However, that is sort of, you need to think about that in context of this little point here, and it's fine. I'm going to spoil it for the purposes of answering your question. That very important sentence in the IOD. Let's say it's very important to keep your feedback simple so that it's easy to understand. So then it's very important. It's very easy to get into the chat, because this is IFRS. This is the type of stuff that I'm hoping you enjoy, like I do. And this is the type of area where I'm sure you guys had robust research with paragraph references and just like technical, complex stuff. But then the specific required asks you to keep it simple and easy to understand, right? And almost so that the feedback is constructive. And it's that could have acts as your sort of limiting factor in responding to this task. And that, yes, there is a lot of things to get through and document on your response, but you need to keep it simple, keep it quick, keep it constructive. And that should have, I'm hoping and keen to hear sort of from your side what this sentence meant for you. This should have then allowed you to sort of scale back and not get too hectic in your response. Because with each issue, let's say issue 1, 3 or 4 sentences should have sufficed to get your point across. So how did you interpret the sentence? Just to get your thoughts, your views on that.
Hi, Asen.
Hi. Sorry. I just wanted to check with Rutendo. Do you have any? Did that sentence limit your response, or did you still go full on technical efforts and sort of write a lot?
No, I think the problem that I did was I took too much time on it, and I had to put too much effort onto it and then ignored other tasks. But I'm getting what you're saying, that in every paper that comes in, there are going to be tasks like this. And you just need to know when to start and when to stop. And as well as you're telling me that it's stated that the feedback needed to be simple, but I didn't quite get that. I skipped that. Anyway, that's okay. But thank you so much for your response.
Okay, cool. And just to finish on, just to sort of latch on one thing that you said, yes. So try to be disciplined in your time allocation, because ultimately, if you don't give every single task its due sort of consideration, you are not going to be successful. So if you don't, if you're not strict with your time, I can already tell you now that your chances of passing are going to reduce significantly. So try and allocate the time plan and stick to it no matter what. Cool, thanks, Rutendo. Atara, you can jump in.
Thanks, Asen. Can you please go back to the page you were showing? I think so. Yeah, the
IOD. Yeah.
No, the sentence. Yeah. I think this time around the mistake I made was I really took what Rian was doing personal. Like, he was irritating me, for lack of a you know. Yeah, so when I saw that he's saying that it is very important that you keep your feedback simple so that I will find it easy to understand, and then he says to understand, and then he says I may not know all your technical CA jargon. I think I caught feelings, and I just took it to another level, because I felt like, why are you calling this CA jargon? Is it not accounting? And as a CFO, are you not supposed to understand those things? So I missed the instruction part of it because I had caught feelings.
Okay, I see. So yes, I guess that is, I mean, yes, as a CFO, CSA, I believe as well, there is that expectation, and there are a few other things that Ryan says that in terms of not keeping up to date with sort of tax, which can be irritating or can sort of be concerning rather. But yeah, it's very important to keep to the instruction and keep it simple. If you don't keep to the instruction, you're now going to be irritating the person that's assessing your script. So yeah, so
I like that.
Hi, Asen.
Hi, Gracious.
Yes, I just want to ask one question. You know, with accounting, when a task is saying keep your feedback simple, sometimes I get a bit confused on how do I keep it simple? Perhaps can you just give one example, if possible? Like, how do you keep something simple for accounting purposes? I don't know if my question makes sense.
Yeah, sure. So complex. If let's use a debenture as an example. If you go and use a definition of a financial liability in IS 32, it speaks to a financial liability being a contractual obligation to deliver cash or another financial asset, and there are all those other criteria. And then IS 32 then goes on to say that you have a contractual obligation, or an issuer rather has a contractual obligation if it does not have the unconditional right to avoid making a cash payment. So complex would be stating that. So in accordance to IS 32, we are the issuer. A contract exists because it has been signed with X party and Y party. This contract results in Archegos having a contractual obligation to deliver cash in the form of, in this case, to deliver cash. And this is evidenced by the fact that it does not have an unconditional right to avoid making a cash payment, because I'll just spoil it again, because the debenture is either settled in converting into tuition fees or a full refund. That's complex. Simple is this debenture meets the financial liability because Archegos has a contractual obligation to deliver cash, because the debenture must be settled either by converting to tuition fees or giving a full refund. So that's literally, that was just like one sentence, quite simple.
So
you
it's
say what it
more
is.
like summarizing. I don't know.
Yeah, absolutely. So you're just getting to the point, right? So you're saying the debenture is financial liability because of this. Whereas complex is like, say, in accordance with the IS 32, financial liability is defined as this. In this scenario, yes, we have a contract. Do you have a contractual obligation? IS 32 further says there's a contractual obligation when there's this. This is the case in this scenario because of that. That's complex.
Or more like you answering an ITC question.
Yes, yeah, that's a good way of putting it. Yes, so complex ITC question, simple, just a normal conversation with a colleague.
Okay, thank you.
Cool. And of course, simple would not include like paragraph. Of course, you can say according to accounting standards, according to IFRS, that's fine. There's no need to go into any detail in terms of accounting standards. Cool. I think let's jump into, unless Linda, do you have another comment?
Yeah, I don't know. I wanted to ask you with regards to this question. Assuming that maybe the RIAN is a CA.
Yeah.
Is it necessary to quote the standard or the paragraph, then later apply it?
Not necessary. Even in a complex, if you ask for like a complex technical response, there's no need to quote a paragraph reference. That's never a requirement. You can speak to the specific standard. So just say IFRS 9 states this, and then proceed to apply it. If the task requires a complex discussion, but if it's a simple discussion, you don't even need to quote the paragraph number. You don't even need to say IFRS 9. You can just say accounting standards or IFRS and just get to the point. Not having to quote the requirements first and then apply.
Okay, but yeah, I had two questions. The other one is
Yeah,
on
go for
the
it. Yeah.
the other one is on the document 6.
Okay, document 6 in the pre-release.
Yeah, exactly. The same. We have also received many requests from parents asking for relief. Yeah, that statement after number 2.
Mhm.
Yes, I think that no, that segment was quite like sort of like I don't know how to explain, but according to me and the discussion I had with the group was like, okay, fine. From me, this sounds like IFRS 9, where I need to do those stage 1, stage 2, stage 3. Then we had a lot of argument there.
Oh, okay. I get you, and why you'd be thinking that. So I'm just trying to find it again. I don't know how I lost it.
I think stage 22.
Cool, thanks. Yes, so I get that point from a sense of if they're asking for relief for tuition fees or they're unable to pay the tuition fees, then you're worried about the credit risk and whether or not and the measurement of expected credit losses and lifetime versus 12-month ECL, or just measuring the probability of default, which is a valid concern to have if you have recognized the revenue. So if you have a debit to the trade receivables, so because remember with every journal entry, there's two legs, right? So when you recognize revenue for this transaction, we either going to debit cash or debit a receivable, and then you're going to credit revenue. And what I'm noticing from sort of these discussions with your question and the question that Atara had initially about the debenture and revenue, is that when we think about accounting, we're only thinking about one side of the journal entry or one side of the transaction, and we're forgetting about the other side. So your concern was with the trade receivable side, and whether this is indicative of an increase or decrease in trade receivables. But then you failed to sort of consider what the impact of this would be on revenue itself or revenue recognition itself. And in terms of revenue recognition, then all those issues come up in terms of if the parents are asking for relief in tuition fees. Is this a scenario where it wasn't catered for in the contract, therefore a modification, or is it catered for in the contract or some sort of policy that Archegos has such that this is actually a variable consideration? So that's the credit side consideration. And yes, your consideration on the debit side of ECL is valid because you could say that maybe because some parents are asking for relief, maybe they're unable to settle any amounts that they owe the school. I hope that helps, Linda.
Yeah, I'm answered, but yeah, if we can continue for the sake of time, then I think I'll just,
Okay.
yeah.
Okay, cool. We can pick it up at a later stage, no problem at all. So let's jump right into the information on the day, because that's where all our discussions will come through. So this was email or document C, email from Ryan to yourself, the financial manager. Good morning. This is getting to be a long day, but just hang in there and you will make it. My email of 30 November 2021 has reference, so that's that email in the pre-release document. I attempted to document the main accounting implications of the various transactions or intended transactions and events with, sorry, let me just move this to change the Wi-Fi here. Cool, I'm back.
Sorry to disturb you.
All right, perfect. No, I'm back.
No,
Right.
let's go back. Sorry.
Yeah.
Yeah, I just wanted to know this implication because I got it from a group members from other programs. I just wanted to confirm it, ne? Because we were writing on the 1st December, and this email, like it came on like on the same day, but there's some emails came back then and whatsoever. I wanted to ask the implications of that. We have some emails coming from maybe I will say, okay, let me just push through. Like they were all not in the same day, sort of.
Oh, like in the pre-release document, somewhere, just checking,
Yeah,
somewhere 29.
29 and whatsoever, because usually it will be like, okay, fine, everything will be assumed will be on the same day and whatsoever. But we had some coming earlier before on the pre-release.
Not a significant sort of impact in terms of I guess your research and context. I guess it would be important to just consider what information you're receiving when, from a sort of overall pre-release information perspective. Maybe that would give sort of additional context in one task or the other. But other than that, not really, not anything of note.
Okay, sorry. The reason why I asked this, someone say like I think because now we are writing on the 1st. If you receive like a information on the 22nd or whatsoever, it's sort of like you need to put more emphasis, or like you need to do more research on that thing. And if it's something that you receive on the 30th, it seems like, I don't know, because this thing it says it's practical.
Yeah, no, I would place equal amount of effort depending on the trigger. I'd place more emphasis on the trigger in terms of the work to be done as opposed to the date that the email was sent to me. Hey, Linda.
No, I'm fine. We can continue.
Okay, cool. Thanks. Right. Cool. With all the financial experience I have, I think I know my debits and my credits and was able to point us in the right direction. I did not attempt to document any tax implications. So first crucial thing, and I guess just a point to highlight, and a common thing that we see in terms of when we are assessing scripts, particularly in our program, is research dumping. So your examiners will try and design your tasks in such a way that one, you can't just prepare, because I mean, with the trigger and how clear it was, the expectation is that you would have come through on the day with robust and quite thorough research. So the first thing as an examiner is to sort of avoid a scenario where you just come and copy paste all of your research and kind of expect to pass. So this is one of the key ways sort of achieving on the day thinking by giving you sort of something that has been done or additional information on the day and expecting you to apply your knowledge in order to review or do some sort of task. So the first key thing to sort of note just from this is the fact that Ryan has attempted to document the main accounting implications of various transactions of the event is that when you respond, which is likely to be some sort of review or something, or give your thoughts on my implications, you always just need to remember to do exactly that, right? So avoid a scenario where you just find yourself discussing accounting implications and then forgetting to link it back to what Ryan has said. So if Ryan says this needs to be that, then you need to agree or disagree to what Ryan has said using your technical sort of knowledge or research to justify your view, right? What we often see is candidates just put their view on a page and forget to come back to critique what Ryan has done. So we're going to do a little bit of that in the hour that we have left. I did not attempt to document any tax implications. They, in this scenario, then you will be, without reading anything further, you will be in a position to, or you would have done enough research in terms of tax implications to then copy or bring through a lot of your research onto your script. So now we'll see later on how an examiner can use another strategy in terms of giving you additional information on the day to avoid that scenario where, because you're having a discussion or you documenting the tax implications, you won't be able to just dump your research on the page because you have additional information that you have to consider on the day. And again, what typically happens is candidates ignore that additional information on the day and always just fall back to just copy pasting their research onto your response. So try and avoid that scenario. But let's read on. So Ryan has attempted to document the implications.
Yeah, no, sorry. I think you can go back to that document. I just wanted to ask something.
Sure.
Let's say for instance, there's a question like similar to this thing, like at the lease or whatsoever, the debentures, and you've seen this question is exactly the same as SICA. And the only thing that you need to do maybe is just to change the names and the dates from there. Will you be penalized just copying the words? Say, no, my English is bad. I don't want to change anything. I'm just going to change the names and whatsoever. Will you be penalized?
That's a very dangerous game to play. And a part of the APC assessment is structured in such a way that you need to demonstrate on the day thinking, and that will be engineered into the exam. So if you find yourself in a scenario where you've done your research, and I can't predict the future, so I don't know what exam is what is going to come up in your exam, but if you find yourself in a position where you sort of think that you can just take your research and copy paste it onto your response, and you think you're going to pass or get a good outcome, there's a high possibility that you're missing something in the task, or that you're not considering information that you've been given on the day. So be careful of that in terms of sort of having sort of a specimen response or a template response, and then just copy pasting it where it will fit, because we find that a lot of candidates spend too much time trying to see how their research will fit into the IOD or rather into the task, as opposed to taking the time to actually read the information that you've been given, read what you've been asked to do, make all the connections, and actually respond to the task, as opposed to trying to figure out how your research fits. I hope that clarifies.
No, I'm not answered. I just want to make, okay, for instance, like we have the Loyana and the PwC reports, ne?
Yeah.
Then you find what's okay, and while you're reading through that, there's a similar case there and whatsoever they solve. And then now you see, now on the day, you see, okay, whatever they ask is similar to that thing. And the only thing that you have to change there is just the dates and whatsoever. Will I be wrong if I just change the dates and the name of the company and whatsoever? It's similar.
It's
not penalized.
You need to respond to the task. So use that information that you get from that document. So what you're reading in that EY or PwC document, whatever knowledge that is, right? Whether it's in relation to a lease modification, what it is. Use that knowledge, study that information, and if you have a lease modification in your task, then just respond to the task, as opposed to just copy pasting and changing names. The chances of that occurring like for like is very slim, first of all. Second of all, the person assessing your script will know that you've copy pasted from a publication online, PwC, or EY. And third of all, there's actually a focus when assessing in ensuring that you have demonstrated that you are thinking on the day and not just copy pasting. So I guess in short, yes, you will be penalized for doing that. You need to respond to the task, not try and copy paste or find an example in EY documents and just change names and dates. That is not responding to the task, and you're not going to be successful if you take that approach.
Okay, well, now I'm answered.
Okay, cool. Thanks, Linda. Tara?
Hi, Asen. I just wanted to also answer the fellow candidate here to say that, like Asen said earlier on, that if you find yourself copying from your file, it's going down. It's not going to end well. So you can use the information for knowledge, but you still need to write with your own words so that you can apply what's being asked, in other words. But yeah, I liked the way you answered as well.
Absolutely. Thanks, Tara. Agreed with that. And thank you. I see T. Chirindo agrees. You need to make it applicable to the scenario and just respond to the task. Okay, so yes, so those are two strategies that will be adopted to ensure that you're doing just that, right? Give you more information on the day, right? To force you to think on your feet. Give you something that has been done already and ask you to review to force you to think on your feet, to avoid that scenario where you just copy paste from your research. Please see the attached document, which I have provided some details or context about each transactional event. So there, the first thing is happening, right? So what has happened in the IOD is that you've been given more information that was not apparent in the pre-release information. So more clarity, confirmations of a few things, which will assist you then to use the knowledge that you've gathered in your research to sort of respond or to this task in the context of these additional details that you've been given. And documented what I believe to be the main financial accounting implications of each. So not only have you been given additional information to consider, you've also been given proposed accounting treatments. Now, because this is an assessment, you can be pretty much sure that there are going to be errors in this proposed treatment that you may need to do something with in terms of responding to the task. Kindly review my document and provide constructive feedback so that I can take this forward and ensure our accounting will keep our auditors off our back. Now, there's the ask, right? So here's the task. Kindly review the document. So using the additional context that you've been given and what Ryan believes to be the correct accounting treatment, review what has been done. So when you read something, ask yourself, what is the accounting treatment of this when you get the additional information? And when you read Ryan's proposed treatment, ask yourself, am I happy or unhappy with what Ryan has said? And also, why are you happy or unhappy with what Ryan has said? In terms of typical pitfalls of candidates responding to these type of tasks, it is the why that's problematic. So typically, candidates will be able to pick up, okay, this is incorrect, but the why will not be there. And that's where depth comes in, right? So coverage is being able to deal with all the issues that are apparent in whatever document Ryan has presented to you. Depth is then being able to properly articulate why you are happy with something or unhappy with something that you are reading in the document, right? So that depth. That is that place where when providing that why, there's one of two ways you can go. It can go either to be a technical discussion or to be a simple discussion. Sometimes that is dictated by your audience, right? So in this scenario, if this scenario didn't have this sentence, right, responding to a CFO, I would have maybe put a little bit more detail in my responses, right, considering who my audience is. However, if my audience was, let's say, the board of directors in general, then I need to take cognizance of the fact, okay, who I'm responding to are various different skills and knowledge bases. In terms of some people will be IFRS experts, but maybe others are not so much. Maybe some are teachers, maybe some are professors. So maybe I shouldn't be too technical about it, right? So the why then will either be super technical or not technical at all, depending on the audience. But here, at least, you were given quite a clear direction in terms of the level of depth that you needed to go in when responding to the task. But we're jumping to a paragraph. Sorry, I just wanted to say that you can see I don't have two screens at the moment, so I actually can't see hands if you raise hands, because what I'm seeing on my screen is what you're seeing on your screen. So please, if you have any questions, any comments, just unmute and jump in. I don't mind at all, and I'll give you space to just ask your question or share your comment. Please also discuss the accounting implications of the archegos of the debentures issued to certain parents. Don't worry about the tax implications of other transactions. So please also discuss the income tax implications for archegos of the debentures issued to certain parents. Okay. So again, like I mentioned earlier, there's a significant risk here for an examiner that you as a candidate are going to come and dump your research on a page and then expect to pass. So one way that examiners mitigate this risk is by providing you additional context or details which you may not have thought about during the pre-lease information until you're given the information in the IOD. So if you come and just copy paste your research, it'll be very apparent that is what you're doing, and you're not considering the additional information you have been given on the day. Don't worry about the tax implications. So I'm going to make this green because that's a task. Please also discuss the income tax implications of the debentures. Don't worry about the income tax implications of the other transactions. So again, just like a negative trigger, that's like I call it a negative task, right? Don't do it. Don't worry about the tax implications of matter 1 and matter 3. If you do so, you're just wasting your time. And we've discussed this point already. It's very important that you keep your feedback simple so that I find it easy to understand. I may not know all the technical CA jargon. So again, we need to keep our responses as simple as possible. Thanks always. Kind regards, Ryan. So let's jump into the attachment to the email so that we can jump into executing our task. Remember the context that we're reading this. We are reviewing the document that has been attached so that we can provide some constructive feedback. So this is the attachment to the email, main accounting implications of various matters. Matter 1, the changes to the lease agreements. Details or context. There were 3 different types of change to our lease agreements. So I'm hoping when you looked at the pre-lease document, you picked up that point in the pre-lease information that it spoke to there being numerous changes to lease agreements. So I'm hoping in your research you prepared yourself for any type of change that can happen to a lease agreement. The lease periods of some of our existing leases were extended without a change to the amount of the individual lease payments. We simply acquire the use of the asset for a longer period of time and continue to pay the same monthly or annual lease payment as previously. What were your thoughts in terms of this change to a lease agreement? What were you guys thinking on the day for a lease that was extended without a change to the amount of the individual lease payments?
Hi, Asen.
Hi.
I thought this was a lease modification.
A lease modification, for what reason?
Because they are changing the, I forgot how the standard calls it, but they're extending the term, so it doesn't qualify for the rent. What is it called? Rent assignment. I lost the terms, but it falls under rent. I mean lease modification because they are changing the contractual terms significantly.
Absolutely. So this is one type of lease remeasurement, right? So I'm hoping as part of your research, you recap subsequent measurement of a lease liability, where you increase it by interest, decrease it by the payment, and then account for a lease remeasurement if applicable. A remeasurement can come in one of three ways, whether there's a reassessment, whether there's a lease modification, which is what we have here, or whether or not there's a change in substance fixed lease payments. So in this case, a lease modification is essentially described as a change in the contractual terms of a lease, where we either change the scope of the lease, or how long or the amount of assets in the lease, or we change the consideration payable under the lease. But this is where we're actually changing the contractual terms. And how can lease modifications be accounted, or how will this lease modification be accounted for specifically? Do we have enough information to make that conclusion? How would this lease modification be accounted for specifically, and do we have enough information to make that conclusion? Also happy to take a step back. How do you account for lease modifications?
Hi, Asen.
Hi, Gracious.
I'm not sure I will try. I think if there's a lease modification, you have to remeasure your right of use asset. So like in this case, the number of years are changing. It means it will have an impact on your right of use asset and your liability. So you remeasure the liability and also the change in the right of use.
Okay, so are you speaking to this lease modification specifically, or just lease modifications in general? Just to clarify.
Lease modification in general.
Okay, so there's a key step that you're missing before we even get there. So we need to assess essentially we need to assess this lease modification in terms of what type of lease modification it is before we can sort of deal with the accounting thereof. Let me just see the comments. Amanda says increase in scope. Yeah, we made it longer. Agreed. We might consider the practical expedient here. Sinawa, please clarify which practical expedient you are referring to, and then we can take it from there. Sinawa, thank you. Someone's mic is unmuted. Does someone want to jump in?
So part of my research, I noted that you can apply the practical expedient if the modification is as a result of COVID-19. So then I think we could also argue that there's no modification or there's no adjustments that need to be made.
Absolutely. Have we been told that this modification is as a result of COVID-19?
Yeah.
Where? I may have missed it.
Page 7, the attachment to the email.
Page 7, this attachment we're both reading here.
Yeah.
So this paragraph here, this is a different modification, a different lease.
Oh, hectic. Okay.
No stress. But I mean, we'll get to this one though, and your point will be valid when you get to number 3. Cool. And then I think somebody got it there in the chat. Asanda, yes, we need to first determine whether or not this is a separate lease or not, right? And IFRS 16 provides us the guidance in terms of assessing whether we account for this modification as a separate lease or not. And it looks to 2 things, right? Has the scope of the lease increased? So is there a new asset? And is the increase in the consideration or the lease payment commensurate to the increase in the scope of the lease? In this scenario, we don't meet those 2 criteria. Therefore, we do not account for this as a brand new lease. Instead, as was mentioned earlier, we account for this modification by remeasuring the lease liability. So taking the new term new or the existing payments over the new term and present valuing those. Do we present value those at the original rate or as at a revised rate?
Good evening, Aston. At the revised
At the
rate.
Fantastic, and that's a key point. It'll be at the revised rate. Now, to go back to that question, that now that I'm thinking about it, between technical and simple, right? Technical, you go through that entire assessment. Technical, you say, this is a lease modification as defined because we've changed the contractual terms and we've increased the scope of the contract. A lease modifications can either be accounted for as a separate or not a separate contract. It is separate when there's an increase in scope by adding a new asset and the consideration increases in a manner that's commensurate to the increase in scope. In this scenario, the consideration does not increase for the increase in scope, or there's no new asset. Therefore, it's not we do not account for the modification as a separate lease. Therefore, it is accounted for like this, right? That's technical, that's hectic. Simple is just going straight to the point. This lease modification will be measuring lease liability. Right, sorry, so this is a lease modification, that discussion remains. This lease modification will be accounted for by remeasuring that lease liability by present valuing the payments over the revised lease term at a revised discount rate. Okay, that is a simple discussion. Okay, what happened to the other side of the journaling? Sorry, yeah, jump in.
Yeah, so if I was answering to the board, that detailed explanation would be correct, and sort of like giving definition, what is a lease modification, and yeah, will that be correct?
So to the board, sorry, go on.
Yes, to the board.
Yeah.
Will that be correct?
So for the board, it's rather simple. Because remember, for the board, first of all, board members are very busy people, and at the same time, they receive board packs that have copious amounts of information. So they need summarized bullet points, they need information as quickly as possible in a simple format. They don't have time to be reading all the requirements in IFRS 16. No, some of them don't have the expertise to understand all that jargon. So for a board, because there's a diverse audience, simple is better.
So how will you then put it if you're now talking to the board?
So
because some of the things like lease modification, how do you simplify that?
Okay, so to discuss a lease modification in a simple manner, contract number 1 meets the definition of a lease modification in terms of IFRS 16 because we have changed the contractual terms of an existing lease agreement by extending its tenor. This lease modification is accounted for by remeasuring the lease liability, by present valuing the existing lease payments over the revised period, discounted at a revised discount rate, which can be the rate implied in the lease, rate implied in the lease, or if not available, the incremental borrowing rate. The corresponding, so this lease remeasurement essentially comes with a corresponding adjustment to the right of use asset. That's a simple discussion.
Wow, okay, thanks.
Cool. Thanks, Gracious. Right, so cool, so lease modification, not a separate lease for the reasons that we have discussed. And we said we're going to remeasure the lease liability. We said this will be using a revised discount rate, which can be either the rate implied in the lease, or if that's not available, the incremental borrowing rate. What happens to the other leg of the journal entry? If we're extending the lease, so it's likely that the lease liability is going to increase. So credit lease liability, where does the debit entry go? Where does the contra entry go? And I could have a comment in the chat for this one. To the asset. Thank you, Kazim. To the right of use asset. Okay, but again, there is technicalities where we are reducing the scope of the contract, which is not happening here. But I'm hoping that you guys are aware of that from your research. Okay. A reduction in the lease payments to reflect changes in market rental rates. Provision was made for such a market rental review in the original contract. How do we account for this? A reduction in lease payments to reflect changes in market rental rates. Provision was made for such market rental review in the original contract.
Hi.
Hello.
Yes, I think the point two, what I can remember is that if the provision was made in the contract, it's not treated as a lease modification.
Absolutely. That's the first key thing to pick up, right? So the provision was included in the original contract, therefore not a lease modification. Therefore, what is it? If not a lease modification, how do we account for this? If not a lease modification, how do we account for this? Absolutely. It is a remeasurement. And more specifically, it is a reassessment event. Okay, so be careful with terminology in IFRS 16. A remeasurement encompasses 3 events. So you can remeasure your lease liability because of a reassessment. You can remeasure a lease liability because of a lease modification, or you can remeasure a lease liability because of a change in an in-substance fixed lease payment. So in this case, this is a reassessment event, and specifically, we are reassessing market rentals, and we're making an adjustment thereof. How do we account for this reassessment? We present value the new rental payments, the lease payments, over the, it will be the original tenor. Do we discount at the original discount rate or a revised discount rate?
Original.
Right, you use the original discount rate. And then where does the debit or credit entry go? So once we remeasure the lease liability, where does the contract go?
It will go to profit and loss.
In certain circumstances.
Are you asking that are there circumstances where it goes to profit or loss, or other circumstances where it goes elsewhere?
Yes, so it doesn't go to profit and loss immediately. So it goes somewhere first, and then it can go to profit and loss in certain circumstances.
Oh, okay. I think there's a technicality with it going to right of use and then with a capping.
Absolutely. It goes to the right of use asset, and if we get rid of it and there's more that we need to adjust, then that excess goes to P&L. Okay, next one. Payment holiday. A payment holiday was granted by one of the lessors as a result of COVID-19. This is effectively a deferral of 6 months lease payments, originally due by 31 December 2021, to a later date by extending the lease term. How do we deal with this?
Hi, Asen.
Hello.
Sorry, can I please take you back a bit?
Sure.
So on the first lease, I have a question with regards to lease reassessments and I mean, lease remeasurement as well as lease modifications. Because when I did the first lease, I thought it's a remeasurement and not a modification. So I'm just trying to understand where I might have went wrong with the first lease and coming to a conclusion that it's a remeasurement and not a modification.
Okay, so a remeasurement is almost like a collective noun, so to speak. So what happened in lease number 1 is that it is a lease remeasurement due to a lease modification. So we remeasure our lease liability as a result of 3 events. One is where we have a reassessment, either a reassessment of our option to purchase, a reassessment of the lease term, right? That option to terminate or option to renew, reassessment of market-related rentals, reassessment of the guaranteed residual. So when we have a reassessment of one of those items, we remeasure our lease liability. Where we have a lease modification, so we change the contractual terms, and it is not accounted for as a separate lease, we remeasure the lease liability. So a remeasurement comes as a result of a lease modification.
Okay, so with the first lease, wasn't this a remeasurement of the lease term or period?
So it was a change to the contractual terms of the contract, therefore a lease modification. And to account for this lease modification, we had to remeasure the lease liability.
Okay.
Maybe if you see the standard, it will help. Let me pull the standard up, wherever it is. If you see how it's worded in the standard, it might help. Where are you? So subsequent measurement of the lease liability. So we need to remeasure the lease liability, remeasure the carrying amount to reflect a reassessment, or remeasure to reflect a lease modification, or remeasure to reflect a revised a change to in substance fixed lease payments. So we remeasure the liability to reflect a lease modification. I hope that helps.
Thank you.
Cool. Okay, let's go back to COVID-19. So how are we going to treat this this modification? So there's a payment holiday that was granted by one of the lessors as a result of the COVID-19 pandemic. This is effectively a deferral for 6 months lease payments, originally due by 31 December 2021 to a later date by extending the lease term. How are we going to account for this one?
Hi, Asen.
Hi.
I think we are going to start by applying the rent concession requirements.
Absolutely. To apply the COVID-19, the rent concession as a result of COVID-19. Absolutely. Where this change or modification, should we meet the requirements, and this lease does, I'm not going to go into detail because of time, we are allowed to apply the practical expedient where we are allowed to not treat this as a lease modification. However, we then have to treat this in accordance with IAS 16. So how do we treat this lease modification? So fine, we're allowed to ignore this lease modification, or in other words, not treat this as a lease modification, but we must still account for this change. How do we account for this payment holiday?
Sorry, Esson, did you say we apply IAS 16 or you meant IFRS 16?
IFRS 16, my apologies.
Okay.
IFRS 16. How do we account for this payment holiday? So it's not a modification, agreed. therefore not a modification. So how do we account for it? What did you guys pick up in your research? Because this was clear, right? This was a very clear trigger on in the pre-release information. At the very least, okay, maybe I've got a comment in the chat here before I go on. No, at the very least, I would have expected you guys to have picked up the amendments to IFRS 16, right? That relate to the concession. Of course, it was extended, so that's lovely. Where is it? Right. So the standard just says, if the lessee shall make the selection, right? So important to note that it is an option. It's a practical expedient. It is not mandatory, right? Probably something worth noting, depending on Ryan's view. Probably an important point to note that it's an option. Should Archegos make the selection? Archegos shall account for any change in the lease payments resulting from the rent concession in the same way that it will account for the change applying the standard if it were not a lease. Sorry, a lease modification. What does that mean?
It means we treat it as a lease reassessment.
Right, we treat it as a lease reassessment, right? So remeasure. Therefore, we remeasure the lease liability. Do you use the original rate or the revised rate?
Original.
Original rate. And where does the contra go?
Profit and loss.
And where did you get that from? Because that's not in the standard. As far as I remember, we said where we have a reassessment, it goes to the right of use asset, right? So where did you get profit and loss from? You're right.
COVID-19 concession.
You're not wrong.
It's the COVID-19 concession that was released in 2020 and extended to cover up to December 2021.
Where? So there it is on the screen. Where does it say the other part goes to profit and loss? Any other takers? Anyone else can jump in? Anyone else that had profit and loss? Where did you get it from?
If you interpret subparagraph C, and then you go up to the standard where there is no substantive change to other terms and conditions of the lease.
Mm-hmm. Where in the standard? Right? In the interest of time, the point that I'm trying to drive home here is it's actually not clear what happens. I'm not sure whether you guys picked that up in your research.
Okay.
It's actually not clear. Right? And this is that. So this is obviously thing that you guys are going to experience in practice in real life, where IFRS is not perfect, right? You learned it IFRS being perfect, but you very quickly realize once you guys are CS or in practice that it really isn't. And there are a lot of areas where it may be unclear, and that's where these guidance documents become a little bit useful for specific when you're doing your research and a specific issue is triggered, and one of these documents is available online, it is sometimes worth sort of going through them and you pick up on these points, because it's very difficult to realize that IFRS doesn't actually cover a specific issue. But the point that I want to drive home is it is then worth noting, right, as sort of like a high level point, or to just demonstrate the depth of your research, that actually IFRS 16 is not clear on how you account or how you apply this practical expedient, and several approaches are relevant, right? And there's no, because remember we're asked to keep it simple, so then I wouldn't go into detail in terms of all of these approaches, right? I would just essentially pick one which I think is relevant or meets the criteria, or sorry, meets the sort of looks like it's a good option to go with. Typically, these documents will tell you that generally in industry, this approach is the one that's adopted. And again, mentioning that point is that higher level thinking, right? It's worth noting, first of all, that there's no guidance in IFRS for this. Second of all, as noted in the EY document, so name drop your sources, because this is a reliable source, EY publication. Noted in the EY sort of publication, there are 3 options. However, this is the option that is mostly adopted by industry, and therefore we're going to debit or credit P&L, and that's essentially approach number 1. But we're not going to go into too much detail. But what I want to highlight here is that point 1. Your research is very important, that you do robust and strong research, particularly with very strong triggers, which this one was 1. That's very clear. 2, where IFRS is unclear, right? State that point. IFRS is not clear. Where you got guidance or things that are done in industry or common in industry from a publication or from whatever source, name drop that source and say, from this source, I got that. Those are typically high-level application points. Okay. And what's the source of this as well?
That was KPMG. Just check on the note number 2.
Yes, I had to read quickly. Absolutely. So then you can also do that. KPMG, that's my source for why it goes to P&L. Okay, thank you, Chirindo. So it looks like your research was also quite robust. Cool, guys. So those are the lease. So now let's read the next point. All our leases. So I think Chirindo, your mic is still unmuted. I'm not sure whether you're happy. I'm hearing feedback. Cool, thank you. All our leases are entered into by particular entities within the group directly with third parties. There are no intercompany leases, right? So that's fantastic. No sort of intercompany stuff I need to be worried about. Main accounting implications. All 3 types of change are substantially the same from an accounting perspective. How do you feel about that statement? All 3 types of leases are substantially the same from an accounting perspective.
Yeah, I think that's a red flag. He's not correct in making that declaration there.
This is incorrect. Yeah, to use your word, this is a red flag. This is not correct. But then it's important to state why. Why is this incorrect? Right? It's all up here, right? So what we typically get from candidates is a dump of this theory, but we often miss that point that says, I am unhappy with the sentence, because they're not all substantially the same. One is a lease modification for these reasons, and we account for it like this. So we're going to get there. One is a lease modification for this reason. One is just a reassessment for this reason, and the other is a modification, but there is an option to apply practical expedient. Okay, so disagree with the statement. Next one. They all result in the lease in an adjustment to the lease liability. Are we comfortable with that?
Yes. Correct. That is correct.
Okay, yes, they all result in a remeasurement of the lease liability. Right, but it is also worth noting, right, that of course they all result in a remeasurement of a lease liability, there's a particular difference in terms of these three types of remeasurements. And what's that particular difference that's worth noting?
It's the discount rate used.
Discount rate, absolutely. All right, next one. Archegos will remeasure the lease liability to reflect the revised lease payments over the remaining term. What are your thoughts on that? Archegos will, yeah, sorry.
Yeah, that sounds correct. That is correct.
Yeah, sounds correct. The adjustment to the liability is recognized in profit and loss.
That now is the incorrect part, because it will then depend with the nature of the reassessment or remeasurement rather.
Absolutely. I love your use of terminology. Now, do you see how to critique this sentence, we had to bring in all of these principles we discussed, right? But it's important to bring in all of these principles we discussed when unpacking the accounting treatment in the context of a constructive review of this, right? Or everything that we've discussed is relevant in the context of a review of that box. And that's how you get your coverage, and that's how you're going to tick all of those competencies in the marking grid. If you just dump the technical principles from your file, you are not going to, you're not going to have demonstrated that you're thinking on the day. Thinking on the day is demonstrated by reviewing this. If you don't do that, you're not going to get a competent outcome. Okay, let's move on to matter 2. Details or context. And I'm cognizant that we're running way out of time, but we will push quickly. I think I'm going to need an extra 15 minutes from you guys, or 30, but I'm targeting.
Sorry, Asen.
Jump in.
Hello.
Hello, I can hear you. Jump in.
No, I'm looking at the time we spent on the first one. Where I'm just asking from time management. When do you stop? Like, if you like, for instance, you still have these other issues that you need to discuss there.
Yeah.
How do you determine if these are key and I can leave these ones out?
Or are you speaking in the context of when you're responding on the task? Not
yes, like, because this task was very long. I won't lie.
Yes.
Yeah.
So to answer your question, you have to cover all of the matters. Just take a step back and ask yourself, if as part of sort of responding, right? What is a competent response? If you are Ryan and you asked your financial manager to review this document that you've prepared, and the financial manager returned to you a review of matter 1 and matter 2 only, would you consider, if you were Ryan, that your financial manager is competent? And you guys can put in the chat what your views are on that, or you can answer me quickly. If you are Ryan, you asked your financial manager to review a document, and the financial manager only reviewed 2 of the 3 items.
No, okay. To say that, I understand. Like, for instance, the same line item, you have a lot of points there, and you still have this lot of points that you need to. How do you determine if these are the key points that I can just state 1, 2, 3, 4, 5, then I move to the next task?
So it depends on what points you need to get your point across. So using this first thing as an example, right? So if you're reviewing this sentence, and remember, it needs to be simple. All 3 types of changes are substantially the same from an accounting perspective, right? What do you need to document on a page to drive home the point that all 3 changes are not substantially the same, right? In a simple manner. So you're going to say something like this. So the first one, is a lease. So first you're going to disagree, right? I disagree with your first point because all the changes are not substantially the same. The first one is a lease modification because there's a change to the contractual terms. The second one is a reassessment event because the change in the market-related rentals was taken into consideration in the original agreement. The third one, although it's a modification because there's a change in the contractual terms, a practical expedient is available in terms of the accounting. So do you see from saying that I've driven home my point in a simple manner? I don't have to copy paste paragraph references or go into copious detail in terms of driving home my point. So to answer your question, how do you know how much is too much or how much you need to write, right? You need to apply your professional judgment in determining how much is enough to drive home your point. And if you ask me for my professional judgment, and you can disagree with me if you have a different view, I think that extract that I just gave, or an example response that I just gave, that is sufficient to drive home my point that all of these three modifications are not substantially the same. Does that help, Linda?
No, it does, because professional judgment sometimes is different to different people.
I know it's tough, and unfortunately, unlike sorry, the summertime. Please just check your mics to make sure that you're muted. We got you. I can't. Okay, there we go. Thank you. It's tough, absolutely, and obviously it comes with frequent practice, just to get the formula or to get an idea or get an understanding of that point. But ultimately, yes. So it requires a lot of professional judgment, and yes, it was possible to go overboard and keep writing a lot of stuff. But to your point, there's just way too much going on, and you just don't have that much time to go into that much detail in anything. And because you asked for a simple sort of response, then do the same thing. Keep it simple. No one requires 3 paragraphs to critique this point. You can literally critique this point in 5 sentences, and you've driven home your point. Okay. Let's push on. Matter number 2, debentures issued to customers. A number of 8% debentures were issued to some of the parents. Now, this is additional context we did not have in the pre-lease information. We didn't know that there was interest on these debentures. Now we know that there is interest. The debentures will be settled by converting them into tuition fees, i.e., instead of Archegos settling the debentures in cash, we will excuse these payments from paying tuition fees. Now, if you are struggling to figure this one out, essentially we're going to receive cash. Let's say cash, and we're going to credit a debenture, right? And maybe you're unsure of what this debenture is. On the other side, you are going to, let's say, debit cash or a receivable, and you're going to credit revenue, right, for the tuition. So what's going on in this debenture
Sorry,
is that...
Ashton, if you can remove cash on this second part, because definitely these people owe us.
Cool.
These parents.
Happy, right? So you have a situation where Archegos owes the...
Is it not supposed to be a debit debentures? Because ultimately we have to, let's say it's a liability, that liability is being decreased through the revenue as we recognize the fees. I'm not sure, I'm just asking.
Oh, absolutely. So when every year, right, we're going to debit debenture. So after the first journal entry, debit debenture, credit, in this case, it would be income received in advance. Right, because remember, this happens at the beginning of the year. And that means, and that's before the services has been provided. So the credit will go to income received in advance. So I'm happy to add that journal entry.
Deferred revenue, right?
Yeah, or deferred revenue. Okay. So what's going on here? So the key to classifying this instrument. So how do standards work? Remember, IFRS 15 is a residual standard, right? So in trying to figure out the accounting treatment of the debenture, we have to first consider that it's not a lease. And I think it's quite clear that it's not a lease. Then we have to consider that sort of financial instrument. Okay, that's where we're busy battling now. And if it's not a financial instrument, then we fall back to essentially IFRS 15. It's more like a residual standard. So then the question is by issuing this debenture as Archegos, does Archegos have a contractual obligation to pay cash or another financial asset to pay it? So we're paying another financial asset. Remember, if we're paying cash, we de-recognize cash, right? So we'll credit cash and then debit the debenture, whatever the case may be, when we're settling. If we're settling in another financial asset, we will de-recognize that other financial asset, so credit the financial asset and debit the debenture when we're settling it. So a key thing that you needed to pick up when classifying this instrument or identify when trying to understand what's going on here is that this bracket here, like I mentioned earlier, instead of Archegos settling the debentures in cash, we will excuse these parents from paying tuition fees. So in other words, this debenture is settled by de-recognizing a receivable. In other words, parent, you no longer owe me for the upfront tuition fee. So it is settled by de-reckon or with the use of another financial asset, or by de-recognizing that receivable, which is a financial asset, right? So at this point, it was already quite clear that this is a financial liability. However, that point sort of gets driven home a little bit more later on. More so, just this point on the interest that needs to be paid, this 8% interest that needs to be paid, that also sounds like a financial liability. So this whole debenture, both the interest piece and the principal piece, are settled in cash or another financial asset, therefore meeting the definition of a financial liability. Right. So that is just one key thing in terms of classifying this instrument. I'm going to save that. The debentures have a 5-year term and are converted into tuition fees in annual portions at the start of each year. So we already spoke about that, i.e. in advance. No early settlement discounts will apply when debentures are converted to the tuition fees, right? So no early settlement will be applicable. Just to get your thoughts on this, right? Or did you guys, and it wasn't the previous information, just curious, what were your thoughts on this? That if a parent invests in this debenture, right? So giving Archegos some cash relief, they lose their entitlement to an early settlement discount. What, from a business acumen perspective, just like a business in general, were your thoughts on this, that the early settlement discount does not apply? Or were you completely comfortable with this?
Yeah, I found that they shortchanged the parents in this case. However, it would be interesting to note that if the discounts were very inconsequential, like if they're very small, then the interest that you earn here kind of compensates you for that. For example, if the discount that they give is just 1%, I mean, what is 1% out of the 8% that I would earn annually?
I just want to type that out. Discount versus the interest of it. And that is absolutely spot on. Right? So absolutely. So I mean, I couldn't have said it any better myself, right? So just like a little bit of business acumen, just a thought that I'm hoping that you guys were having during the pre-release period in terms of these early settlement discounts that are not available on the debentures. Thanks for that. The debentures are fully refundable in cash should the learner leave the school for whatever reason. And at this point, if you were still in doubt, at the very least, at this point is when you should have definitely concluded definitively that this is a financial liability. Because Archegos cannot avoid paying cash, because Archegos cannot control whether a learner leaves the school. So if the parent takes the learner out of the school, Archegos has a contractual obligation to refund the cash. So at this point, you should have concluded that this is definitely a financial liability. So if they are not settled in the form of tuition fees, the outstanding balance is settled in cash. Main accounting implications. The debenture liability is jumping. Yeah.
So on that statement, do we then have to do a provision of some sort? I don't know.
Provision for?
I mean, like for in case some of the learners
leave.
Yeah.
Good question. But remember, it's already reflected in the lease in the financial liability. So the financial liability reflects our contractual obligation to pay cash. So if a learner leaves, we're just going to credit cash and we'll debit the debenture to reduce it. So there's no need to raise a provision.
Okay.
Cool. It's already provided for in the measurement of the financial liability. But it's not a provision. Okay, so I know I've used the word provided for, but it's not a provision, it's a financial liability. Jump in.
Sorry,
Yep. Sure.
I don't know if I can recall very well, but somewhere around there, they say like the sort of a deposit of which is non-refundable.
Where?
That's why I say I can't recall very well. But
Okay, but what's the question in the context of the non-refundable deposit?
Do we have to raise this provision, or do you recognize that revenue as a whole if it's non-refundable?
So if it's non-refundable, it will still meet the definition of a financial liability because of the point that I just made up here, right? Because ultimately we're settling this debenture by forgiving future receivables from the parent. So would still meet the definition of a financial liability. Therefore, would still raise a financial liability and not a provision or revenue.
Okay. Okay. With that being said, I wanted to ask, if someone leaves and we have this deposit of which is non-refundable, how do you treat that one?
Then if that happens, then because it's not refundable, then you can just de-recognize that the portion of the debenture and recognize income.
Okay, thanks.
Cool.
Austin, I'm just not sure in the journals that you have there under debit, debenture, credit, income, and advance where everything fits in. Happy with the fact that day one we receive cash and we have to represent the credit through our obligation.
Yeah.
And then at the time that we actually perform in the year in which we perform, we can recognize the revenue every month and recognize the receivable and then net off the debenture by derecognizing the receivable and debiting the debenture.
Okay, so let me just change. So I'll put this down here to explain the point of settling the debenture using a receivable.
Yeah.
Put the proper.
Yeah, so I think the second part is just a bit confusing for me. Yeah.
Absolutely. So I'm just going to put this line here just to make it clear that this is something else. Okay, let's assume that school fees per year is 100,000 rands.
Yeah.
So at the beginning of the year, on the first day of the year, we're going to de-recognize a portion of the debenture, and then we're going to recognize income received in advance. So this is the first day of the year. I think it's the 1st of Jan every year. And then as the year goes on, we're going to debit income in advance. Okay, let's just say school fees in a year is 120 to make our life easier.
Wait, can I just pause you there? Because for here, it says that the debentures have a 5-year term. So for example, if your child is in grade 8, you've paid for the full 4 or 5 years they're in school.
Yeah.
So in advance. So in essence, don't you only, so I still don't see where this credit comes in at that point.
Which credit?
The income received in advance part.
Okay, so this happens 1 Jan 2021, let's say for argument's sake. This happens 1 Jan 2021 at the beginning of the year.
Okay.
Okay, this happens 31 December 2021. Wait, what happened? Ah man, sorry, I clicked escape. So now this thing deleted all my thingies. So just give me a second while I pull it back. Okay, on 31 December 2021, debit income in advance. So this is at the end of the year. Credit revenue. All right, and then on 1 Jan 2022, again, do that. I'm ignoring interest for now here because interest gets paid.
Yeah.
And then 31 December 2022, we do this. Is that clearer?
Yeah, it is a bit clearer.
Cool.
Thank you.
No problem.
Sorry, it's not clear on my side.
Yeah.
Sorry, yeah, can you please go up again? So I see every year you are crediting revenue and you debiting your income received in advance, which is a balance sheet item, right? Then when do you clear it? Because I see this 200,000 building up every year, but then where does it go?
Building up where? Because here we recognize it, income in advance, and then here we recognize it.
So, oh, sorry, I didn't see that other part. Okay.
Cool, sorted.
Yeah, so now the last journal, like at the end, the one where you debit receivable and you credit revenue.
That one, ignore this journal entry because for this, I was just trying to explain settling using another financial asset. So you can ignore it. Yeah. In fact, I'll delete it. Yeah, because I think it's causing more confusion than it's worth.
Okay. Is deferred revenue and income received in advance essentially the same thing?
Yeah, the income received by deferred revenue or contract liability, same thing.
Okay.
Just a naming convention. The technically correct term is contract liability.
All right.
Yeah.
Cool. Thank you.
No problem. Okay, let's have a look at what has been said. The debenture liability is recorded equal to the cash amount received when they were issued. What are our thoughts on this? A debenture liability is reported equal to the cash amount received when they were issued. What are our thoughts?
I think this is in contradiction with IFRS 9, which says financial liability should be measured at its fair value at initial recognition.
Absolutely.
Lovely.
I think someone's unmuted again. Cool. Absolutely. Phenomenal observation, right? Typically, the cash amount transferred, so the transaction price, typically equals the fair value. However, in demonstrating that that critical thinking, right? You are saying that it needs to be at fair value. The amount transferred can be the fair value. However, I would need more information to make that determination, right? That's an absolutely fantastic point to raise. What information would you need to determine whether or not the amount transferred is fair value? So now
I think the interest rate plays a big role, the market-related interest rate.
Absolutely. So we compare the market-related interest rate with what?
With the coupon on this particular debenture. Absolutely.
And that is a significant point to raise with Ryan. That what you're saying is correct if the market-related interest rate equals 8%. What happens if it doesn't? Then the fair value will be different to the one in my example, 1 million. It won't, the fair value won't be 1 million. So let's say the cash transferred, the transaction price rather, is 1 million. But let's say the fair value is 980. What happens?
Day one losses.
Absolutely. In this case, it would be day one gain. Yeah, thank you, because liability. Absolutely, guys. So this is you're now demonstrating a high order of thinking, because ultimately it wasn't specifically triggered in the pre-release information, the measurement considerations, but clearly it still formed part of your research, and you still were able to raise that question. That's high order thinking. Good work. Interest expense is recognized every year with a corresponding cash outflow when we pay the interest over to the debenture holders. What are your thoughts on this? Interest expense is recognized every year with a corresponding cash outflow. So it sounds like interest expense corresponds with the cash outflow when we pay the interest over to the debenture holders. What are your thoughts?
Yeah, I think this is incorrect because it's ignoring the accrual of interest, which has nothing to do with payments.
Absolutely. And how do we accrue for interest in IFRS 9?
Using the effective interest rate.
Absolutely. We accrue for interest using the effective interest rate method. Fantastic work. Absolutely agree. We don't do cash accounting. At the start of each year, when a portion of the debenture is settled, we reduce the liability with a corresponding increase in tuition fees. What are your thoughts?
I consider this to be correct. The principle is correct, and it's in line with the fact that tuition is payable in advance. Therefore, we should reduce that debenture liability. Yeah, but however, it's not a corresponding increase to revenue, because IFRS 15 requires us to recognize revenue over time as we deliver the performance obligation.
Absolutely. And how you have articulated it, simple. To the point, simple. Technical would have started going into that discussion about, okay, the three requirements of when revenue is advanced, then we meet the simultaneous exchange of performance and benefit. Therefore, that's complicated. How you've explained it, simple. You've got your point across, move on, right? And if you take that approach, how you see how you quickly just dealt with it, you would have finished this task. It'll take you a bit longer because it's a long task, but you would have finished if you kept your responses or your critiques that concise, right? So great work. Not revenue, but instead a contract liability or revenue in advance or whatever. Yeah, I'll just keep it at that. I think you guys know the other ways we can skin this cat in the interest of time. Okay, there's a journal entry. Another thing that I just want to mention in terms of journal entries, typically candidates love journals. So if you're asked to discuss the accounting treatment or critique or review something, you want to squeeze in a journal entry or two in there, right? So be careful with that. With journals, put them in if you're asked for them. If you're not asked for it, there's no need to put a journal entry in your response, right? I know it's comfortable, I know it feels like home, but if you haven't been asked for a journal entry, don't put journals in your response. Okay, for instance, to make my point, you didn't have to put these types of journal entries when responding to matter number 2. Okay, so now I'm cognizant of time, guys. So I'm just going to run through matter number 3 very quickly. And then we can just close off with some few closing remarks. Gracious. No, you have your mind is perfectly capable of passing this exam with flying colors. You don't need mine. Matter 3, rebates on tuition fees. Details or context. A subcommittee of our KGOS board has approved fee rebates to be granted to financially deserving households in terms of certain specified criteria. These rebates are granted in advance at the start of the school year or as soon as applications for rebates have been approved. What are we thinking? So a subcommittee of our KGOS board has approved the fee rebates to be granted to financially deserving households in terms of certain specified criteria. The rebates are granted in advance at the start of the school year or as soon as applications for rebates have been approved. Now, to take a step back, we didn't actually discuss this, but we didn't discuss it for anything. But for the specific rebates from the revenue side of things, what was the concern during the pre-lease period? Besides the ECL that was triggered, that was spoken about, somebody asked a question about expected credit losses. What other types of things did you guys research in terms of what could potentially be the accounting impact of these rebates?
If I can go in first, Esson.
Jump in.
My thinking is to try and look at IFRS 15 saying we should recognize revenue to the extent that we expect, to receive whatever compensation for it. So in other words, a rebate means we're no longer expecting to receive anything further than what we have reduced the fees to.
Okay, and which part of IFRS 15 does that concept land in? So we're not sure how much we're going to receive.
Oh, it's the it's the recognition of the revenue. It's not the transaction price, but.
Okay, so you sort of right at the beginning where you try to determine whether there's a contract.
No. I was actually like generally summarizing like whether it's rebates or whatever. IFRS 15 always emphasizes the amount that the entity expects to receive.
Absolutely, and that's the definition of what? What's the definition of?
Transaction price.
Absolutely, that's the definition of a transaction price, right? Transaction price is what we expect to receive for transferring their goods and services in IFRS 15. So rebates, as you correctly pointed out, affects the amount of money that we expect to receive. So in particular, when we're dealing with rebates, we're worried about variable consideration. All right, but that is if the contract caters for these rebates already, right? But it seems like these rebates can be granted in advance at the beginning or at a later stage, as soon as applications for rebates have been approved, right? Now, what questions do you have about these rebates as soon as they are approved? Do you have any questions or concerns, or rather, let me put it differently. Is the accounting for rebates granted in advance, this in terms of IFRS 15, the same as those that are granted at a later stage?
I think they're different because there comes an issue of contract modification.
Absolutely. However, what if it's covered in a policy? So the contract itself does not cater for these rebates, but our KGOS as a school has a policy of granting rebates where families are, an existing policy rather, where it grants rebates to families that are deserving for various reasons. It can be COVID, it can be anything. What happens then?
I'll take a guess and assume that we should have kind of like a percentage or an expectation from our revenue, how much is going to be rebates?
Absolutely. So for leading from your point, sorry, does someone else want to jump in? No. So leading from your point, yes, so it's already catered for in a policy, and this variability when dealing with variable consideration can either come from the contract itself or come from an established policy that the company has, right? Or later, if there is an established policy in place. Okay, it can get more complex if there's an existing practice of doing so, right? But that's not being that doesn't seem to be an issue here. But in terms of thinking about how we deal with these rebates, there's a lot of it depends. So it depends on whether or not it's in advance or during, and if it's during, it depends on whether or not it's in the policy or if it's if it as a result of modifying the contract to either add the rebate in to reduce the amount we're paying. These rebates are not the same as the early settlement discounts that are granted to parents that settled tuition fees in advance. Rather, the rebates represent a reduction of fees to the amount approved for the rebate for that year for households that cannot afford to pay the tuition fee amount. Parents can apply for this rebate throughout the year, i.e. it is not just at the beginning of the year. So in other words, these rebates represent a reduction in school fees, right? So a reduction in net transaction price, therefore variable consideration. Now just remember with variable consideration, you first estimate the variable consideration and then you constrain it so that you don't have a significant reversal of revenue in future when you have more clarity. Let's look at the accounting implications. When granted, the rebates are recognized as an expense for our KGOS when the corresponding reduction to the customer's account. Are you guys happy with that?
No, no, I won't be happy with that.
Yeah, not happy. Why not?
No, because it must reduce revenue.
Absolutely.
Not expense.
Absolutely. Okay, I believe maybe this could have been how these type of things were accounted for in the past. Would have been before my time. But now with IFRS 15, we reduce revenue. We don't do this expense stuff. All right, cool. And to sort of justify this point, this is the discussion we're going to be having. Now, to demonstrate your critical thinking, you're going to, it's okay to say that there isn't enough information. As you can, we finished reading this, and we actually don't know whether or not for these applications that happen throughout the year, we don't know whether or not it's catered for in the contract. We don't know whether or not there's a policy. We don't know whether or not there's an established practice, right? But it would be worth highlighting this to Ryan and say, listen, the ones that are before the school starts, okay, that's variable consideration, right? However, the ones that happen throughout the year, I need more information to make a conclusion on these ones because it could go one of three ways. And in order to land on the conclusion, I need to know whether or not it's either in the contract already, or if it's sitting in a policy, or if our KGOS has an established practice. Now, that information could be in the pre-release information. I don't believe it is, where it says somewhere in the pre-release or somewhere in the IOD that, oh, our KGOS has a policy for these rebates, or our KGOS has a established practice of providing these rebates, right? Then you're showing that second order of thinking, where you're linking information from different parts of the scenario, pre-release or IOD, to drive home your point. But where you don't have the information, you don't have the information, and it is what it is. Okay, to finish up, guys, tax, right? Don't forget all elements of the task. From a tax perspective, these are debentures, interest-bearing instruments. So which tax implications will be applicable for an interest-bearing instrument? What section or tax implications for an interest-bearing instrument? Thank you, Halalelo, section 24J. And I think section 24J is nice and standard enough that I'm not going to go into detail in terms of discussing it, right? You guys know yield to maturity. In terms of getting the deduction, remember, it must be carrying on a trade, which Archegos is, and it must be in the production of income. We don't have enough information to make that conclusion. Therefore, you can just highlight that point. And of course, the revenue side of things, right? So remember, both the loan is being settled, but at the same time, we're generating revenue on the other side. So that would be a gross income inclusion, right? So the capital piece for the purposes of Section 24J, capital in nature, no tax implications when we settle the debenture. But on the other side, when we use the settlement of the debenture to recognize revenue, that's a taxable event, gross income inclusion. All right, but again, two very basic tax sort of concepts. So I believe that I don't need to go into too much detail on that. All right, any questions, guys? I know I've kept you for an extra 30 minutes. Thank you for that, for sticking around. Any further questions before we wrap up this evening's session?
Hi, Asen.
Hi. Are you jumping?
Oh, I was saying, I wanted to ask, what are the tax implications for the rebate?
On the caveat that it was not required, right? Remember, with the rebate, it's not going to be a deduction, right? SARS will just include in gross income what you have received, or what is accrued to you, or what you have given cash. So it will just be the number after the rebate.
Okay. All right. Thank you.
And the same for the lease, or the lease stuff. So again, SARS will just grant you as a deduction the amount that you have incurred under the lease. So after those modifications, so those modification stuff, those are all accounting adjustments. Of course, that will create deferred tax, right? Because for accounting, we're doing all this fancy footwork, but for tax just says you get a deduction when you incur it. It could create some funny deferred tax implications, but the matter number 1 and matter number 3, the tax implications are quite straightforward. It's matter number 2 it was interesting, and I think that's why they just asked you for matter number 2, tax implications. Okay, guys, I think that's pretty much it. Thank you again for your time and giving me the extra 30 minutes. Have a fantastic evening further. The next round of reflection videos are going to be released when they're according to the timetable. So be sure to watch those before your next round of feedback sessions next week. Okay, have a good evening further, everyone. Have a fantastic weekend until we meet again. Thank you very much for all the engagement. I really enjoyed it. Okay, thanks, and I see all the thank yous in the chat.
Thanks, Asen. Will you be able to share the document with